our end of April quarter, or March quarter, but recording end of April after a couple of long weekends for the financial and economic update. So as always, I'm joined by Kenneth Bentley. Welcome, Kenneth. Interesting times, to say the least, at the moment. So the topic today is obviously war, inflation, and what it means for investments. But, you know, if we look at the backdrop today, we've got, rising inflation. We've got rising interest rates, war with Russia and Ukraine, energy crisis, slowing China, slowing Europe, and it makes a really interesting backdrop for where to position your investments. So hopefully we'll get it. The process today is just get a bit of overview of what that all looks like, and then feed that into how we position our investments. All right, well, we might kick this off. All right, Kenneth.
Over to me. Yep. So inflation, it's dominating headlines at the moment. And what we thought would be beneficial is maybe just move back a couple of years and really think about how we got to this point. Because for really 30 odd years, inflation hasn't been a big issue. We've been talking about lower interest rates from the 1980s through to really just the end of last year. And so what's happened recently is nothing short of phenomenal. And what we want to do is try to explain to people how and the economic environments into which how we've actually got here. So, look, if we think back even from 2018 to 2020, we were talking about deflationary aspects. Yep. We were seeing the RBA cut interest rates. We were talking around trying to spur economic activity. And inflation is a gauge of how much, or really the positivity in economics. So if you're a consumer and you're getting good wage growth, there's a healthy price increases, it's actually good for the economy. And that's why you see Federal Reserve, the RBA, really target a specific band, because we definitely don't want deflation. Deflation, if you're a consumer and you think a price of a good is going to fall in the future, you don't want to buy it now. You'll prolong your expenditure and it becomes a spiral. And so what we saw really through 2020 was the complete shutdown of the global economy. We had the virus, and governments rightly, and the central banks again rightly, pumped huge amounts of liquidity into the financial markets, and they actually went direct to the consumer. So you and I, it's a proven strategy. We saw it in the global financial crisis. It's the right thing to do. Now, really what happens when you've got a load of cash given to you and you can't really spend it, you go or you can't use services, you'll go and look for goods, or you'll look for assets in which to place those funds.
Yeah.
And that's really the start of how we came into an inflationary period. We have cashed up consumers, we've got ample liquidity in financial markets, and so from the back end of 2020 right the way through, we've seen inflation expectations and inflation start to really ratchet up. Now, I did touch on it before. Central banks are really focused on inflation, and they try and keep it in a nice healthy band between 2-3% roughly, and that's what the RBA looks for. When we're coming out of the crisis, the RBA explicitly stated, because they really haven't hit that benchmark for quite some time, that they were prepared to have inflation overshoot, so let inflation run higher than their upper end of 3% in order to get unemployment back down. And unemployment is another key focus for the RBA, because if you get unemployment down to a natural rate, you start to see wage pressures. And that's good inflation. You want to see healthy wage increases. What you don't want to see is unexpected inflation. You don't want to see inflation run at a higher level than, say, wage increases, because what that does is it actually affects the real income of you and I, or the consumer. You have a lower real income to go out and spend.
So, and a good example of that is with the energy crisis at the moment.
Correct, and we'll touch on that a little bit later. But if there is unexpected shocks to inflation, it's actually a bad thing. And so what we've seen is inflation run at a much higher level for a longer or a more sustained period than anyone was really predicting, even six months ago. The current state of what we're seeing in Australia isn't quite as bad, and again I'll touch on that. But the headline number in the US is 8.5% at the moment, and you have to go back to 1981 to see any sort of type of inflationary environment like that. Now, whether it does start to peel off, you will have base effects, so rolling, cycling numbers from higher periods will be interesting. But you've also got really big pushes, like you said, into energy, keeping that sustained period of inflation higher, and commodities are also running at pretty significant multi-year highs as well. But we just thought one little quote that I thought was important to share was from the International Monetary Fund's economic and director of research said, inflation has become a clear and present danger for many countries. And so it is a real factor that people are looking at, and that's why it's dominating headlines right now.
The underlying theme that you're running with here at the moment is, what I'm taking from you, is really around the good part of inflation, which is the growth.
Correct.
The wage growth, the economic growth. So if we get this inflationary figures up and we don't see that economic growth, then we enter into a stagflation environment.
That's
our greatest concern.
That's right. And you actually will see, and when inflation ratchets up, and it's higher and sustained higher than wage growth, you'll actually see that start to pull economic activity back and force you into a recession. So it's not a good thing to have in terms of a sustained period where you're running at levels that start to really affect people's wages, real incomes. So what does this mean? What does high inflation mean? Well, in simple terms, it means borrowing costs are going to start going up. People are going to see that the RBA will start increasing. We've already seen interest rates increasing in the US, and they're forecast at least to increase at quite a rapid rate. The reason for that, central banks want to squash the inflation issue. They want to pull that back. Now, it's not as easy to do if those inflationary shocks are from non-domestic or non-domestic activity. So we're looking at energy crisis. We're looking at commodities. Raising interest rates isn't going to bring the price of gas down for Europe at present. It will, however, decrease demand, and I think that's what they're trying to do. What it will be a really interesting position is when inflation remains high, but economic growth comes back, and that's that stagflation issue that we think is a higher probability. But with inflation running hot, you will see the RBA really follow the US Federal Reserve and start to move interest rates. So the right-hand side here, what we've shown is just the expectations of where interest rates will be at the end of this year. And while moving from 0.1% at the moment up to, say, 1.25% doesn't seem like a lot, it's actually going to be quite a significant change for investors, both in equity markets, in housing markets, and just a general rebase. So we're our expectation, the market expectations, is this is going to mean higher borrowing costs moving forward. You will see, or hopefully see, higher savings rates, and term deposit rates have started to move. But if wages don't pick up and you don't see that growth that we've seen in the US come through to Australia, you will see a reduction in real incomes for Australians. So the other side that is happening at the moment, and it's really the exogenous effects of the war in Ukraine, the pent-up demand that we've seen over the last 2 years is in the commodities and energy markets. Really, we were actually seeing a very strong oil and energy market prior to the war in Ukraine. The right-hand side, I think, is absolutely fascinating. And the source is Trading Economics. What you can see is just the year-on-year changes for some of the energy inputs. Coal, which I think even 2 years ago no one would have thought was ever going to have another run again, tops the pops at 250% year-on-year increase. That will go into our electricity costs. You can't get around that. Natural gas, again, a huge input into a lot of industrials. So these are huge effects, and they were actually starting to build as the demand picture for economic activity started to rise over the last 2 years. Clearly, the big impact, and it's being felt a lot in Europe, is the Russian-Ukraine conflict. So it's now putting really severe pressure on industrials in that region, but it does have a flow-on effect. We think that there will be some margin pressure felt through a lot of companies. But with the demand side, and there has been some issues with China, and we'll touch on them later, but the demand side for energy, particularly for gasoline use, it picks up in the Northern Hemisphere. We're going to see travel again. I think there's pent-up demand. So we're coming into a pretty interesting time for energy markets. I thought this was a great slide, and really what it's showing is the Russia and Ukraine exports, or basically their main exports. Now, I think when you think about Russia and Ukraine, you don't immediately think about global GDP because they're tiny. They don't actually put much economic activity through in terms of a global picture. But what they do is they have huge amounts of agricultural and energy exports to the world, but predominantly through Europe. So you can see, exports out of Russia, 30% for crude, another 16% for petroleum. They're quite big in terms of gas as well. The other side of to this picture is what's happening with Ukraine. They are a massive wheat producer in terms of a global scale, or soft commodity, agricultural commodities. And that's what you're seeing, a really big increase in terms of staple commodity type price inflation. And so it's all building. And it's all feeding through into those unexpected inflation expectations that we've seen.
And it's hard to when you sort of break it down and you see the higher energy costs, soft commodities, in the wheat and that flowing through. It really comes back to being able to pass those input costs on to the end consumer, which is where we're seeing, where we will continue to see those inflationary pressures.
That's right. Mm-hmm. So the other area of note is clearly what's happening in China now recently, and that's why we put the graph in to the right hand side. Is China continues to follow a zero COVID type policy, and the way in which they're doing that is they're locking regions down. That spike to the right hand side is real. It's not an aberration. In terms of the statistical data there, and it's now going to put quite a dampening effect on terms of their commodity thirst, and a real material risk to China's GDP. It's also, I think, important to note around their property market. So, our previous our previous webinar, we spoke about Evergrande and the issues around their property sector. And that's a really big GDP contributor for China. That's around 20 to 30%, which is absolutely massive. So if you're seeing lockdowns, you've got a weak property market, and they're not escaping inflation either. It is cause for concern around their economy, and it's a risk for our commodity markets. Really, we saw quite a steep fall in terms of iron ore at the back end of last year. Now, that was to do with the Evergrande situation. We've then seen that come right back to, if you took out last year's record high, it would have been a new record high this year, about $150 US a tonne for iron ore. That started to peel off again, and people are looking at China very, very closely at present.
So the greatest concern with China is obviously the slowing of their economy.
Without a doubt.
Without a doubt. And you've even started, if you look outside of these, the COVID cases and concern about the demand, we've even started to see some of that indirectly through, some of their exposures with some of the Alibaba.
Yeah, a lot of the consumer discretionaries, in stocks or technology stocks as well have been under pressure. Yeah. That's a separate, or we believe that's a separate issue. So if you're thinking about the tech stocks, the Chinese government had a regulatory crackdown. That's all to do with the power and manipulation of data that these companies control. Now, I think you could potentially point to Jack Ma's comments or anti-comments around regulatory findings that he had taken issue with from the Chinese Communist Party. That might have been the real cause there, but it does look like that's
more relaxed.
Yeah, starting to abate. That's a separate issue to what's happening with their economy. Yeah. So what does this all mean for markets, both defensive and equities? And I think this is a really important slide. What are the implications for Australian investors or the Australian economy? So we are a huge exporter of coal. You've seen commodity markets really ratchet up in terms of the tightness of supply. And that left-hand side there is just around commodity price or a commodity price index. And you can see that really for the last 22 years, we're at a cyclical high. Now, you don't want to be chasing that last marginal dollar in terms of a commodity. They are cyclical. They will be downturns. But at the moment, wheat, energy, and commodities have really, really benefited in terms of what's been happening over in Eastern Europe. So
I guess the challenge there is it's not a clear cycle duration there with Eastern Europe.
No, you're right. It could be quite a prolonged issue. But even if the war ceases, I don't think you'll see sanctions roll off.
Not for some time.
No. So it's delicately poised in terms of the multi-year highs that we've seen for some of these commodities and how long they can actually maintain that. But again, the other side is wheat, and we touched on Ukraine. We're actually a huge exporter of wheat, and it's fantastic to see our farmers benefit in terms of price rises. So really, that's I think the crux of what's happening in terms of the Australian economy that's being affected by this Russian conflict. Something that we are monitoring closely. Now, before we get into equities and shares, property, the defensive asset class, this has been the hardest area that we've seen for decades to invest. Now, when we talk about rising interest rates and inflation expectations and pushing those interest rates higher, that means that if you're holding a long-term bond or a negative yielding bond, that you're now no longer being compensated correctly. And we have seen an absolute bond rout, which means the people have been selling and the yields have been rising. That's inversely proportional to the price of a bond. Yep. You can see the massive takeoff in terms of what's happening in the treasury markets and the treasury yields. So if you see that huge big upswing to the bottom right, that actually means that the same's happening, but reverse in terms of the price.
The capital price.
So the defensive asset classes at present is really, really difficult area. what we're strongly focusing on is floating rate exposures, so capital notes, preference shares, where you've got a quasi-inflation hedge. So a lot of these, and we'll talk domestically for a second, are priced off the bank bill swap rate. And that bank bill swap rate tends to rise and fall in unison with the RBA's cash rate. There is a slight difference, but if you're expecting the RBA to move interest rates up, you want to have the same level of income, or try to have the same level of income as inflation moves up. And that way, in terms of capital notes and preference shares, you have a fixed margin, or a treasury note that's inflation protected, you'll have a fixed margin, and that fixed margin will get paid above a rising swap rate.
So it's a risk to the interest rates to the upside, because you've got a fixed margin above a 90-day or 180-day bank bill rate.
Mm-hmm.
We've got a rise in interest return on
a distribution
on our
that's our expectation, because bonds can really, or any sort of fixed interest note can really, there's only two ways that it can reprice. So if you're holding a fixed rate note, you can't change that rate. So it's the capital value that moves. So you've got more volatility in that. If you've got a floating rate note, well, you've got a portion that can move up and down, which is the floating rate. And so you're getting less volatility in that capital note as well.
And with our tier one exposures, we're seeing about a margin of about 2.8%.
Correct. There has been a bit of a repricing. So if we look at what's happening we focus on yield to maturity. We've actually seen those move out from about 3% up to about that 4%. But that's in terms of around about a 3-year maturity level. Clearly, the longer you go out, the more you're compensated for that risk at present. Now, I know we've spent time on inflation, what's happening in the Russia-Ukraine conflict and rising interest rates. But we always want to make sure that we're focusing on what's important. And really, at the end of the day, what a company's doing, or what an economy's doing in terms of being able to produce growth, is really what's going to drive markets in the end.
Yep.
And I think when we look through the last reporting season, which was a couple of months ago, it was really pleasing to see. We had a record dividend season. Yes, we had a slight decline in terms of the industrials, but it was more than propped up by the commodities. So the big end of town BHPs, the Rios, the Fortescues, we haven't seen a top of the cycle M&A activity yet. And so what they've been doing is being quite disciplined, paying cash out to investors and waiting for opportunities. And so
it's actually been a pretty better to see some of instead of the silly M&As when you see some ridiculous numbers and you look at it and you find out years later there's a destruction of capital there. We're seeing some good capital management programs with buybacks. Correct. And some significant buybacks happening at the moment too.
Yeah, agreed. Very, very different to some of the takeovers we saw in the tech sector towards the end of last year, where 30 times forward revenues were being bandied about. And there's been absolute destruction in terms of ultra high growth names over the past 9 months now. But I did want to focus a little bit more on this slide. So the upper right hand side, just showing you the dividends and what we've seen. It is just the industrials on the right, and a slight pullback there. But importantly, we have seen some reasonable revisions, and we've seen quite big revisions in terms of the financials. Really pleasing to see, because they are such a major index weight.
Yep.
Now, if you look around the world, our market, we have fantastic financials, we have fantastic resource companies, and we're highly profitable. We're a dividend type. We've got the franking system to thank for that, but we're quite a dividend orientated total return market. If you're focusing on inflation and wanting to not carry too much duration risk in terms of your earnings profile, so duration risk, if you're going to get paid 10, 15, 20 years down the track, that's long duration in terms of waiting for your earnings. As interest rates rise and discount rates increase, that return profile that we're talking about, that discounted cash flow, that will be more impacted because of the length of time that you're discounting at a higher rate than focusing on profits now. And we're seeing a marked outperformance in terms of the domestic market. And the reason for that is the financials, the resources, and the fact that we've got good profitability. Now, with all these rising input costs, it is something that we are looking at, and we definitely want to be focusing on any sort of margin compression that we or potentially may see moving into the back end of FY22 and beyond.
So the market's favourably nosed with good cash flows now, as opposed to, particularly in the tech stocks, we've seen some discounting on high growth, high PEs with future growth with a higher discounting rate.
Correct. So if we looked at the Australian accumulation index, and it's clearly going to move around today, but we're basically outperforming the world market by about 9%, which is huge.
I think these things are important to keep in mind, because coming back to the core focus here is, your bottom line, earnings will always win in the end. If we do see volatility in our markets, and particularly when we've got so many macroeconomic themes happening at the moment, that you do have to look at your sectors and focus on your longer term investment horizons, focus on the balance sheet strength and their position in their marketplace, and the sustainable competitive advantages, one of the things that we talk about and focus on, because the flip side to that is cash. And with a high inflationary environment, you're going to end up with a real negative return. And so cash is not necessarily it's not your longer term solution.
No, I think when times get tough and you're seeing a lot of volatility in markets, that you've always got to come back to your investment strategy. What's my asset allocation? Why have I done this for X, Y, Z reasons? And make sure that you're focusing on those goals. Now, whether that's all in equities or all in floating rate notes or a balance between the two, I think that's the real important message that you've got to convey to clients. Yep. So what we're looking at right now with all the things that we just went through, in terms of asset allocations, we are quite favourable, or continue to be quite favourable in terms of Australian equities. We think that the profitability of some of our larger companies is really quite sound, and something that international investors will continue to hunt for. Now, where we've sort of remained underweight, and we will split this into two, is the fixed income. So going back to those fixed rate bonds, we've been underweight really from the first quarter. Nothing has changed in terms of the second quarter. The caveat to that is we continue to preference capital notes and hybrid securities. We like the floating rate aspect of those, and so we've maintained our positions in that particular sub-asset class. Remain neutral on property and infrastructure. I know that there's a lot of calls out there in terms of a large correction in the property market. I don't think anyone really wants to see that. The Australian consumer, their largest asset is typically the house, and that will have a major implication for the Australian economy if that were to occur. We're really thinking it's going to be more of a flat market where people will absorb higher interest rates. We did see comments from Matthew Coyne in terms of the ability of the Australian consumer to handle interest rates up to about 1.25%. So we don't think the property prices will go on forever. It's just more of a flat environment. In terms of infrastructure, yes, usually their cash flows are linked to CPI, so they should be charging more if we see inflation run up. The flip side to that, and the reason why we're sort of, I would say, neutral on it, is in terms of they've got large amounts of debt. So you're going to see those rising borrowing costs start to affect their margins as well. Yeah. The only other, I think, interesting part is that our equity strategy team have just slightly moved up their cash weighting. And I think the reason why is we're actually starting to see some pretty good or comparatively good interest rates being shot through. So we were speaking about one just last week at about 1.9%, and we haven't seen that for quite some time in terms of term deposit rates.
Yeah, and a little bit of that. I mean, banks obviously deal with their own funding requirements, but we're seeing that the facility available to the banks that was provided a few years ago,
the term funding facility,
that's
starting to roll off,
and so repayments of those. So even from the one we saw yesterday, looking at it again this morning, and another 10 basis points higher.
Oh, there you go.
So so expect that to continue.
Now, we always do this. We like to keep ourselves honest. We want to look at what we were focusing on. And I've got to be honest, I think between now and back in September, it's really pleasing to see that we did persist with the overweight call, remained with the commodity exposure. We held firm with a couple of, I would say, underloved positions in terms of Endeavour and Lendlease that have done quite well. We did sell out of PEXA, so that was actually quite fortuitous. And really, I think there is always the bad one, Tyro. So what happened there was the operational leverage that we were expecting did not occur. It was really around a reopening trade where people would be spending more, and it wasn't to be. In terms of the financials, it's been pleasing to see that we did see some off-market buybacks. We have seen increased dividends, and that the insurers, outside of a disastrous wet season, should really benefit, I think, from rising interest rates. So the next slide will show you what we're focusing on now. Really, it's around the quality of assets. So, and I think, again, between the two, and we can send this out to people, is a lot of the same names keep showing up. So we do like balance sheet strength. We are very cognizant of the fact that when you have low interest rates, everyone looks good. But on the flip side, when borrowing costs start going up, you don't want to be on the over-levered positions. And so making sure that internationally that we're taking on really quality exposures that we think will last through cycles. You mentioned high growth. The tech sector has been in really, really difficult times, and it's simply the fact that people were overpaying for growth, in our opinion, for a lot of those companies. But the competitive advantage of, say, a Google and a Microsoft, we think will continue to be able to pass through any sort of input costs and drive earnings. And that's going back to a company being able to really, maybe not excel, but get through a tougher environment for growth assets as really discounts start to rise, or interest rates start to rise.
I thought I actually saw this morning an announcement overnight for Google buyback.
So both Microsoft and Google reported last night. Google missed, so it's down about 6% in aftermarket, but a slight miss. And then Microsoft,
capital management.
They are
doing a buyback. Yeah.
And then Microsoft was actually pleasingly a beat. So we'll see. It was a very difficult night on the Nasdaq last night, but we do think that these bellwethers
still quite significant year-on-year growth though with Google.
It was about 25%. Yeah. So they are stalwarts. We think that the flywheel effect, but they're near 90% market penetration of search. You've got YouTube in there. Is just a fantastic ad business, and will continue. Yep. Again, very much in the same vein as our two major techs, is really looking at defensive healthcare. Now, we've held these for a number of years. You would have seen these names pop up. They have had really a bit of a tough time in terms of seeing a PE contraction because of those interest rate movements or inflation expectations. But these are quality businesses that will, in our opinion, be able to navigate these sorts of environments that we're in right now. And so ResMed will report on Thursday, Sonic Healthcare and CSL, just some of our three preferred at present. Healthcare, very defensive. We tend to see that people will pay and take on the price increases that we do see. So very comfortable with those at present. And then going back to a potential for stagflation. And so what tends to happen in stagflationary environments, inflation's high, economic growth is weak. So people tend to not focus on companies that are linked to economic growth, but they want to maintain a store of wealth. And so gold tends to do, or historically has done, really, really well in those types of environments. So Northern Star, ALQ, which is a minerals testing company, and then GDX, which is an ETF in terms of global gold miners. Dividends and capital management, I think, is some of the bellwethers of what we like to see in terms of boards being comfortable with companies and companies' balance sheets. It's a great sign for Australia's business. I did touch on this previously, but the margins will be in focus. Rising input costs, are companies able to pass this through to the end consumer? I think is going to dominate the reporting season when we move into it in July. Just recently, we've been trimming back some of the, I would say, cyclical exposures. So a particular coal company that we've taken profits on, a particular lithium company that we've taken profits on. It's really just making sure that we're not holding things through cycles in terms of cyclical energy exposure. Still really like some of the stalwarts. So we hold our positions in BHP, we hold our positions in Woodside. Those type of ones, it's just peeling back slowly but surely. The consumer still in strong shape. So Wesfarmers predominantly derives its income at the moment through Bunnings, fantastic business. Aristocrat Leisure, very much engaged in gaming, and then Endeavour, which is Dan Murphy's and pubs and clubs across Australia. I think, everyone's got to be cognizant that interest rates are starting to rise. We have a lot of debt in terms of Australia or globally. And so we are watching for any sort of APRA or prudential regulations to flow through if the property market remains or continues to increase. It is a potential negative. And then going back to the floating rate note exposures. This just gives you a little bit of some of the longer dated exposures that we're looking at in the hybrid market. So a Commonwealth Bank hybrid note, yield to maturity, so on an annualized basis, including capital ups and downs, you're looking at about 5.5%, and then an NAB capital note at about 5.6%. Just a little bit of a run through about what we've been doing in terms of our Australian equity models. What you've seen is the income model materially outperform over the past 12 months, which wasn't always the case. I think really from that period where we had that low growth environment, people were searching for higher growth companies, and to the detriment of some of our financials and indeed some of our commodity companies. So really pleasing to see that one has been the real star, if I had to be honest, over the last year and a half. Keep going through. This is just the balanced. 1 year, it's been a little bit stagnant, or in terms of, I suppose, against the XJ accumulation index, really roughly in line. The reason why this and the growth over the last year has peeled back is just in terms of some of the constituents. So some of the high quality businesses, and I touched on those healthcare companies. Yep. We maintain our preference to those companies. Even though we have seen a PED rate, the earnings we think will drive these through this cycle. Again, this is the growth. Great to see long-term performance there. We're very comfortable with it. And then our new position, which is the ethical portfolio, it is just young, so you're going to see a lot of volatility within those. But the main reason for the underperformance at present is in terms of energy and coal markets that have just gone absolutely ballistic.
Very good. All right, we've gone over time a bit, but well worth the conversation, because I mean there are a lot of moving parts at the moment, and in these investment thematics, and really trying to position your portfolio. Coming back to that is really just focusing on, what's important right now. So understand what those markets are, but the key driver, are these indicators of inflation, rising interest rates. Can they pass on these input costs? How to, their position in their marketplace. It's all about their cash flow and their ability to sustain their margins at the moment. So, you can see that going through the focus on, the last time we did a report till now. You're right, it hasn't changed that much in the commodity, which you'd hope not too much anyway, too dramatic. But in the commodity space, just picking up a little bit of gold exposure for the inflationary hedging. But other than that, it's really just focusing on inflation, interest rates, and we'll keep looking at these fixed interest markets as well. So outside of that, there's not too much more to report on. Very good. All right. Well, thank you very much for taking the time to listen. Thank you, Kenneth.
My pleasure.
And we look forward to chatting next time and seeing how we're positioned.
Sounds good. Cheers.
Thank you.